Hello students, today's topic is on pricing concepts. Under this concept, we're going to have understand about the meaning of price, the importance of pricing, and then finally we're going to have discuss about the various methods that normally organizations are using for pricing, right? So first we're going to have discussed on price. So here the price have two major concepts, that is to the consumer. Price is the cost of something. So whatever the consumers are paying towards owning any kind of product, then it's considered as a price. So that is the first concept. Then second concept, to the seller, price is revenue and profit source. So after selling a particular product, whatever the seller or producer made, against that they got the revenue, that is the price, right? And that revenue have also the source of the profit. Now price is that which is given up in an exchange to acquire a good or services. So price is anything that exchange, or you can say given against any kind of product that are acquiring by the customers or consumers. So whenever you are giving, whenever you are paying any amount for acquiring any kind of goods or services, then it's called a price, right? Then the importance of price. First, that the most important thing is revenue. The price charged to customers multiplied by the number of units sold. So whatever the price that seller or producers have charged against a particular product, then that is that is the source of revenue. And whatever the units of products sellers have sold multiply by the per unit price, then it will call it like a revenue. Then profit is what? Revenue minus expenses. So one more thing is there, whatever the revenue sellers have got, the seller should have to minus the expenses also from that, and when they have minus that expenses, then the profit will come, right? Now the same thing that we have discussed right now is in the form of equation on your screen. Revenue equal to unit price multiplied by number of units sold, and that is the equation, or you can say that is the concept of revenue. Whatever the unit price of a particular product and the number of units sold into the market, if you're going to have multiply both of it, then you will get the value of revenue. And revenue pays for every activity, and this is the revenue, and that is the revenue which pays for every activity that a seller or manufacturer did, right? What's left over is profit. So I already told you, while manufacturing any product, while selling any product, certain kinds of costs also required to sell, to manufacture that product, for the raw material, for the distribution channels, for the people who are involved under that selling processes. So a lot of things are involved in a particular product's manufacturing and its sale. So that involvement of deployment of the resources has also cost something. And when you are going to minus that particular cost from the revenue that they have got from the sale of the product, then profit is left over, right? Marketers must select a price that is too high, not too high, or not too low. A price that equals the perceived value to target consumers. So according to this, the pricing should not be much high, the pricing should not be much low, but it should be more or less towards the perceived value. Perceived value means what exactly the customers are perceiving towards uh, the value of any product, right? For example, if I'm going to ask you to pay 100 rupees for a normal bread packet, then you're not going to pay for it until unless that bread is properly marketed into the market with a tag of the premium bread, right? If if I'm going to ask you to pay an amount of 100 rupees for a normal bread, you're not going to pay. Why? Because the perceived value for you, the perceived value in the eyes of the consumer for a particular bread is 25, 50 rupees only, right? So that perceived value is basically for every product in the eyes of the consumers, but it depends. That perceived value can be changed based on what kind of promotional strategies normally marketers are used to sell that product, right? Then trends in the market, the trends influencing the price settings. What are the factors that influences the price setting? High rate of new product information introduction. Whenever the new products are introducing in the market, that can be the one of the factor that influences the price. Then increased availability of bargain priced dealer and generic brands. So if it also depend upon the what are different kinds of dealers are available to provide that particular product into the market. Specifically, they have used one word, bargain price. Bargain price means when someone is going to have negotiate for a particular pricing, right? Then price cutting as a strategy to maintain or regain the market share. So price cutting also have one of the factor that influences the price setting. Like if the producer wants to maintain that particular market or regain market share, then that price can fluctuate according to that. Or the last one is a more efficient and better informed buyers. So even in the marketers in the market, when the buyers are more efficient and they are more informed, and that time also you're not in a position to charge much high from them, right? Then so there are factors that basically influencing the trends of price setting. Then profit maximization, setting prices so that the total revenue is as large as possible relative to total cost. So the crunch and the you can say the summary, or you can say the conclusion of that particular sentence is the profit maximization should only be achieved when the sellers can charge high pricing, and that pricing should have increased the total revenue in such a way that the revenues and the cost difference should be more. Whatever the revenue the company have got from the sale of that particular product, and whatever the total cost incurred for selling that product, it should be that difference should be more. Then the more the difference will be there, the more the profit maximization will be there, right? Then return on investment also one of the concept related to pricing. What is that? Net profit after taxes divided by total assets. So whatever the net profit the company have achieved after paid off the taxes and the total assets the company have, that is the ROI. Mainly the rate of investment, return on investment is normally company has analyzed because they want to see that whatever the business they are in, what kind of return that business is given to them, right? Okay. Then the cost determinant of price. Under this, first we're going to have understand that what are different kinds of types of cost. They are one is the variable cost, another one the fixed cost. Variable cost is normally changed by the level of output. Deviate the changes in level of output. The more the output will be there, the more the company has to deploy the resources for producing that output, right? So variable cost is based on that, right? Because the level of output is there, more the less the cost is going to varying accordingly, right? But the fixed cost is normally not much deviated. For example, the machineries maintenance is the rent, the electricity bill of that particular premises. These are all more or less fixed. But if you're going to have increase your production, output is become more, then the raw material will be needed more. The more a number of employees you have required to produce more number of products and to sell that similar products. So these are all basically involved under type of cost. One is variable cost, another one is fixed cost. Then methods to use set price under the cost determinant of price is, first one is markup pricing and second one is break even pricing. Markup pricing is what the cost of buying the product from the producer plus amounts for profit and for expenses not otherwise accounted for. So markup pricing is basically what, whenever the producer or the seller has add two values over the cost that is basically incurred for producing that product. So for example, if for producing a pen the cost per unit is rupees 1.80, right? And then if that seller is going to sell that particular pen at rupees 220, then markup is 0.40. It means that 0.40 they have accounted for two things. First thing, the profit margin, and second thing, whatever the expenses that seller or producer have bear to sell that product into the market other than production cost. Understood? And here that 0.40 is 20%, 22% of total cost. So this is the total markup pricing concept. Then another one is break-even pricing concept. In this particular concept, the seller should have to decide that at what value of a particular product and what should be the production unit, so that I'm going to get a particular break even point, no profit of no loss. Here on your screen there's a one particular paragraph. Now you will see here for a particular product the pricing here is approx 3,500. So if at this cost total unit should be that going to sell should be 2,500. If the company is going to sell total unit of 2,500 at the certain price, then only the company have in a position of break even. It means that they can able to get the variable cost also, and they can able to get the fixed cost also, right? And that is why there are two lines are here. One line is of orange color. That line start from 2000. Why? Because fixed cost is always be fixed, we're not going to have reduced it. And the variable cost that is in the form of gray color, that going to increase with the increase of production, right? So here at this point, that is the total unit that they have to produce is 2,500. If they're going to produce less than that particular can say point, then the loss will be there, and if they're going to produce more than that, then the profit will be there, right? So this blue line is total revenue and this orange line is total cost. So the cost is going to increase when after the fixed cost only, because this is fixed and this is going to vary with the increase in production, right? So break even pricing is basically very effective pricing strategies, because it's makes the organization to understand or to forecasting at what level of production the company should going to start getting the profit, right? And that is why you will see that maximum of the company, all of the company have this targeted value of sale. Why every time the sales team have so much of pressure? Because if that much of unit of sale is not achieved by the company, then company should have to bear a loss, because they are selling that particular product at certain price, and that price is fixed on these facts only. If you're not going to sell that much of unit, that much of target, it means that whatever the value they have fixed for that particular product is not going to be sufficient for the company to get the profit, right? So these are all overall about break-even pricing. Now, other determinants of pricing also. Uh, I will I will do one thing. I will take this particular topic, other determinants plus ethics in our next lecture, right?